We're off.
All right. Hello, everyone, and welcome to an introduction to ag taxes, what new farmers should know. I'm Sarah Campbell. I'm USDA's beginning farmer and rancher coordinator for the department. So I work on issues related to beginning farmers and ranchers. So this is what new farmers need to do to manage their business fits into that. So I am working with our everybody at FSA and USDA, as well as our partners from the National Tax Extension Committee on bringing tax resources to producers. So this webinar is part of that project. You can go to farmers.gov/taxes to learn more, as well as ruraltax.org. We have a whole suite of resources and information that are for folks to kind of explore and interact with, and we are updating that regularly. So keep checking back as more tax resources get developed. But today we're going to be talking about an introduction to taxes, what new farmers should know, kind of who's a farmer, and how to choose a tax preparer. We have Rob Holcomb from the University of Minnesota. He's an extension educator in ag business management with us today, and Tammy Cushing from the University of Florida. She is an extension assistant professor of forest business, and Bob Ray from the University of Illinois Tax School, who's also an extension specialist on taxation. So you've got some really great folks here today, and I'm going to hand it over to them in just a moment. But a few kind of housekeeping notes. We are recording this webinar here. Looks like we are live. Somebody turned that on, so good. If you have questions, please put them in the Q&A. We'll be going through that and checking that throughout the presentation. We've allowed a lot of time at the end for questions, so don't worry if we don't get to it during the talk. We're going to be monitoring that throughout. And once this webinar is done, we will be transcribing it. That does tend to take us a little bit of time because we do caption it, and it will be posted online with the slide deck and a bunch of handouts and the sort of fact sheets that everybody references during their presentation. So there will be a whole suite of materials as well as the recording available to folks after the webinar. It just sometimes takes a week or two to get all of that posted. So just to give folks a sort of time frame on that. But without further ado, I'm going to turn it over to our presenters. Thanks for joining us, everyone.
Well, good afternoon, and thank you, Sarah. And it's the pleasure of the National Farm Income Tax Extension Committee to be a part of this brand new program with the USDA as we work to provide more information from a tax and accounting standpoint for farm families across the United States. This is a terrific partnership, and we have some of the best people in the nation who teach tax school activities to professionals all season long. They spend other parts of the year drafting and creating that content and material. And then we gather once a month as a group to stay tuned into what some of the hot topics are. So there is no doubt in my mind that you will enjoy this discussion today among Tammy, Rob, and myself as we think about rural tax education and introducing everybody to ag taxes. And Rob's going to run our slides. So Mr. Holcomb, flip us to the next acknowledgement disclaimer, because we want to be sure that everybody knows this is a USDA educational program. We are not providing official tax opinions nor endorsing any products at this point, but we are all about providing good education information to the attendees here today, and would encourage you to continue working with your local tax professionals for your specific situations. But we're glad to answer questions about general tax topics, especially as it relates to farm families in the United States. Rob, this is a unique project. It's a 3-year program that just is getting underway. This is really the first public presentation of our effort. USDA and FSA saw the need to provide information for beginning farmers and ranchers, those who are in the commercial activities that are producing lots of the food, fuel, and fiber for our great nation, especially those who are socially disadvantaged and need additional information in their local areas. And whether you're a landowner, you're a farm operator, you're a consultant, you're a tax preparer, any way that we can provide some added information to make your tax season more productive, that's what we're hoping to do. We know the tax code is an ever-changing, large animal that needs lots of attention. And the people that will be joining us today know a lot of their way around the tax code, especially as it applies to farm families. So we're anxious to get this 3-year program underway. We have a website, and you see the QR code that's there as well. The host for the rural tax education, ruraltax.org website, is Ruby Ward at the Utah State University. And the National Farm Income Tax Committee is the group who is designing the curriculum and content to come together for this series of information, again, that we're starting today. You see many of the topics that are already completed and has information on the website that you can gather, use, implement, study of how it might impact your specific farm clients or farm operation. Lots of good information there, as well as lots of good resources by the many, many people across our state who represent their land grant universities in the mission of income tax education for farm families. Rob, we're going to keep rolling along here with one more administrative piece before we get into the content. We're going to cover 2 topics today. Who's a farmer for tax purposes? And I know that sounds like a simple question, but as Rob will begin to tell us, it's complex and varies depending on what you're asking the question about. But we want to be sure we know who farmers are, what their advantages are in filing tax returns, what some of their special requirements might be. We'll get into all that in a moment. Tammy will lead the discussion of choosing a tax professional. As I mentioned earlier, we're all about the education mission in this program today. And we know there will be more details that will be necessary to prepare a complete and accurate tax return for a farmer as we conclude 2022. So choose a tax professional wisely, one who can help you apply the law, apply the knowledge we'll provide today to that specific farm family for their specific benefit. A lot of the things we'll see today, the questions will come up, and Rob's first answer is going to be, it depends. All right, Rob, it depends a lot on what we're doing, what we're asking about, and how that affects that specific farm family. Very few people are similar. Everybody has different ages, different families, different net worths, different farm operations. So clearly, Tammy's content on choosing a tax professional will be meaningful to you. We identify a couple of fact sheets that are available also on the tax.org website, which some of our information today is based upon. So Rob, let's get into the meat of this conversation here at 108. So good afternoon, Mr. Holcomb, and glad to see you joining us from the great state of Minnesota. I'm on the campus at the University of Illinois in Champaign, and Tammy is joining us from far south in the Florida state. So we're going to talk about farmers and non-farmers, and Rob's going to get us right away into some of the key distinctions between those who we call farmers and those who are not, and including what types of schedules we'll look at in preparing their tax return. Rob, good afternoon.
Hey, good afternoon, Bob. Appreciate that gracious introduction. Again, I'm Rob Holcomb. I'm with the University of Minnesota. I'm actually located in the southwestern part of the state, county seat town called Marshall. That's my hometown. It's where our regional office is, where I'm officed. And I do appreciate the opportunity to be with you here today. As far as what we want to key this discussion off with is just a discussion of eventually we're going to get to the point where we're going to differentiate between what's farm income and what's not farm income. And we normally will start that discussion off with where it gets reported. All right, on the tax return, everybody's going to file a 1040 for their personal return. if you have farm income is going to be reported on Schedule F. I mean, that's a form set aside for reporting farm income and expense. Now, for all other non-incorporated or businesses that are not operating under a formal business entity, they're going to, a non-farm business is going to file under a Schedule C. All right. So for instance, if you had an unincorporated hardware store, for instance, in town, I mean, now most are going to be set up under a formal entity, but if you had an unincorporated or a hardware store operating without a formal entity, they'd file on a Schedule C. Which is just very similar to Schedule F, but it's for reporting non-farm income. So that's where those two, once we separate that out, that's where that gets reported on the tax return itself. Now, we'll get to some definitions a little bit later, but somebody might be calling themselves a farmer when IRS has a way of assigning a designation of whether somebody is a farmer in IRS's eyes, and that's where our discussion is going to lead us here in the coming moments. So you could have somebody filing some farm income on Schedule F, but they don't necessarily meet the qualifications of a farmer in IRS's eyes, so they don't qualify for some of the advantages that an IRS designated farmer through the IRS's eyes gets. So
Rob, before you leave,
yes,
before you jump away from that slide, let me add one more piece here. As we're talking about individuals, we would in both cases, we would say these people are also self-employed, which leads to some other unique criteria. But as we think about individual proprietors, both Schedule F and Schedule C people are going to be under the broader category of self-employed individuals too, which has impacts in some of the definitions Rob's going to bring us to next as we look at a couple of examples, Rob.
yes. All right. Thanks, Bob. And Bob and I are we're going to kind of tag team this a little bit through this section. But what we have here is we have this is actually a material that was pulled from one of the fact sheets on the ruraltax.org website. But here's some examples of somebody that would qualify, as would qualify as having farm income. Up here at the top, we've got Bob. Well, he's engaged in raising wheat, and he sells the wheat to the local elevator. Obviously, that's agricultural production. It's farm income. Rosa has got a flock of milking goats, and she's selling the milk to a local co-op. Again, production of farm products. Amal grows cut flowers, and farming is not only just production of food and fiber, but it's also horticultural production. So in this case, flowers or products out of a greenhouse, that would also qualify as farm income. Ricardo's raising lettuce and cabbage and selling it to a local processing company. Again, food production going to be farm income. Louisa's got a cattle ranch and she's selling calves to a feedlot investor. And again, production, agricultural production is going to qualify us as farm income. Now, what we as I sometimes say, we want to add a layer to the onion as we're explaining this. All of these examples are cases of where the producer was growing that product. Now, there was no further processing that went into this. All right, if we're selling just the raw commodity, farmer grows corn and sells it to the elevator, or any of these other examples that we see here, in an unmanufactured or unchanged state, essentially, we're not doing any processing or anything to that commodity, it's going to be considered farm income. Once we process it, then it starts to become muddied where it may not necessarily be farm income. Now, let's give a couple of examples on this where we could split the farm and the non-farm income. One of the areas, one of the businesses that I see cropping up all over the country, especially in the state of Minnesota, is we're seeing vineyards and wineries crop up all over the place. Producer they'll plant grapes, and then they'll also build a facility to make wine out of that out of their grape production. Well, let's break this down. Production of grapes, if they're just selling grapes, that's agricultural production. We're not processing those things in any way, so that's going to be considered farm income. Now, once we process those grapes and we turn it into wine or juice or jelly, right? Since we went through this process, that makes that income non-farm income. All right. So where we draw the line here is, the sale of the, if they're selling grapes in this case, that's going to be reported on Schedule F. All right. The sale of anything processed out of that is going to be Schedule C. All right. Non-farm business. And we'll find out momentarily why that's important. Another key example that we run into, and this is kind of part of the agritourism, if you've ever heard of this. A couple real good examples that we see a lot, and I think these are popular all over the country. For instance, you might have a local producer that has an apple orchard. All right. And in the fall, oftentimes they'll open up their farm to sort of an agritourism type of thing. They'll have hay rides. They'll have maybe a corn maze. There's just a multitude of things that people will come in there. It's kind of a tourism type of thing. But as part of that apple orchard, when they sell apples in an unmanufactured state, that's Schedule F income. All right. Or same thing with pumpkins. I mean, a lot of times the apple orchards and a pumpkin patch, they may sell pumpkins as part of this as well. Sale of apples and pumpkins are going to be Schedule F. Now, if they're selling apple bread or apple cobbler or apple cider out of that's going to be manufactured pieces from the raw product. That's going to be a Schedule C, because what we've done is we've processed that raw product so that it's in some type of a manufactured piece.
Hey, Rob, that's just as a trivia question. Did you know that Illinois is one of the top 2 pumpkin producing states in the nation?
It wouldn't surprise me.
I did not know that. It's not far from here in Champaign. We're spending a lot of time on this definition, Rob, but I wanted to highlight it is so critical of which form you're filing, because as we'll begin to see here in a moment, I think farm operations, Rob, have some very unique, absolutely true, but also some very favorable tax treatments available to them as a Schedule C filer compared to the Schedule, or as a Schedule F filer compared to the other Schedule C filers. Would you generally agree with that broad statement? There are some distinct tax advantages to be a Schedule F filer.
Absolutely. There are really big advantages to being a Schedule F filer versus a Schedule C.
We'll get to some of those in a second. And I know your next slide, Rob, has a little exception to all these rules. And this is one that is popular at our house, I know, is this next product when you go to the next slide. What about honey? It is Schedule F as farm income, even though it appears to be a processed product, I guess, Rob, but the raw honey itself is really just the raw product. I suppose if you make that into honey butter or honey bread or something, then you're switching to a Schedule C filer.
Correct. But the interpretation of that, Bob, is that if you are as you extract the honey from the hive, there's a comb, kind of a waxy comb that's in with that. and oftentimes that's filtered out. And now the process of filtering that out and bottling the honey, that's still Schedule F. Now, for instance, my daughter and wife last weekend, they went to the Marshall farmers market, and my daughter came home with a bottle of honey that still had the comb in there. So it's very common to package that up in a small operation.
Well, guys, Rob, we've covered grapes and wine and jelly and apples and pumpkins and cider and honey. No wonder we're so interested in helping our farm families get rolling. This is an appetizing discussion already.
Absolutely. So as far as the actual definition goes, now the generic definition, and let me clarify one thing on the slides. And I see there were questions in the chat was a PDF of the slides going to be available? And the answer to that is yes. I think the folks at USDA are going to administer that. But in many of these slides, you're going to see some authority citations. Now, we're not putting that in there to impress anybody. In this case, I'm referring to this IRC section 2032 AE4. IRC stands for Internal Revenue Code. All right, so this is the part of the code which is that's the law passed by Congress, where we find all of our top level tax law that's out there. We put this in the material so that if, when you're visiting with your tax professional down the road, this might be something that the tax professional wants to further investigate, you've got the authority here that you can say, okay, well, here's something, you can look it up, and here's the part of the code where you can find that. But this generic definition is real simple. It just includes stock, dairy, poultry, fruit, fur-bearing animals, truck farms, which a truck farm is essentially a vegetable farm, plantations, which is timber, ranches, nurseries, ranges, greenhouses, and other similar structures, raising agriculture, horticultural commodities, orchards or woodlands are included in that. So it's a pretty broad definition of what's going to qualify as a farm. If you're producing agricultural commodities, that in the I think the practical sense of the word is going to be what we're looking for.
Hey, Rob, we have a couple of questions on this topic, but would you mind hitting those a little bit? And I think I know a couple of these, but we might have to visit a bit about a couple as well. But one of those is about when we're moving in your grape example to wine or jelly, is there a transfer price that's triggered to identify Schedule F income, gross receipts of the product, which would then create a cost of goods sold on the Schedule C? My experience has been, no, we've not used transfer prices. It's up to the individual taxpayer to identify to what extent the revenue arises from production and to what extent the revenue arises from the processed product. Have you had transfer price experiences, Rob, different than that?
I have not touched a lot of returns on this, but we had some information in our land grant university tax education book, had a chapter on this within the last 5 years, and it did utilize a transfer price where there was actually a sale to the farm, and there was a cost of goods sold then to the wine, and that's the way that's the way that we taught that in the tax schools within the last 5 years. We'll have some contact information at the end of the webinar. What I'd suggest is maybe reach out to me via email, and I could certainly follow up with that individual on that.
I think the transfer process is always a little tricky because you sort of have an opportunity to self-select where the net revenue might lie. So as long as you're using a market-based process, I think you like the transfer price in Rob's method would be successful. This is about a livestock one, Rob. If you sell half or quarter cows, is that Schedule F or Schedule C income? And I think we might even consider a third form we haven't mentioned yet. There could be some 4797 income perhaps
Yes.
in a cow transaction. Rob, what's your take about selling cows?
Well, I think it depends on what the state of the cow is at the time of the sale. If you are taking the cow and your cow or steer or whatever the animal is, and you're selling it on the hoof and the buyer is responsible for processing, that's a slam dunk that's Schedule F. If you are, if the farmer is taking the animal to the meat locker, having it processed and where it's packaged meat, and then it's sold under those circumstances, then it's going to be Schedule C.
Right, and if you're just selling a bred cow or a cull cow on the open market, we're going to be looking at Form 4797 as a breeding stock if they've been used in breeding purposes. Mushrooms, Rob, you have mushrooms in Minnesota. We don't have any of those in Eastern or Western Illinois, but dried mushrooms, Schedule C or Schedule F. What's your take about that one, Rob?
That one, it's processed, but I'm still thinking I'd be inclined. That's kind of a gray area. I'd be inclined to say Schedule F with that.
I think so, and it might depend what the market is and to what extent the producer was responsible for input costs and land costs, machinery costs, and if a lot of processing occurred, that would make me think more about a Schedule C. But I'm going to land on Schedule F with Rob initially. And then one more before we move to the next slide, Rob. Maple syrup. Yeah, let's keep adding good flavored things here, but that sounds like farm income to me too. So
no, Bob, I'm afraid I disagree. If they're processing it, because what they're doing is there's a extensive boiling process that goes into
yeah,
the maple syrup.
After it's been processed. Exactly.
So I'd be inclined to say Schedule C on that.
I think I was just thinking if they tapped it out of the tree and delivered that raw product, but that's probably not what the question is about. So
yeah,
all right, very good.
Yeah.
So
yeah. All right, Tammy, go ahead.
Just to pop in on the maple syrup, because I think that's a fabulous question. Doing some digging here while we're going. So these are live questions and answers as fast as we can type it up. There seems to be some disagreement on whether maple syrup production is farming or not. I'm seeing cases where it's actually successfully gone through, and then other times where it hasn't. So there's got to be some very specific reasons why they are not getting through that filter as farming. So all that to say that I don't see a solid answer on it.
I think thanks for that additional commentary, Tam. That's very helpful because we did get to the forestry area quicker than we thought for the day. So that's Tammy's bread and butter to keep our theme of food moving here. But I think the more it's about a raw product, the more it's about Schedule F. The more it's about a processed product, the more it's about a Schedule C. Rob, let's move on forward to defining a farm. And this is one of the reasons we're so interested in getting the right definition, because the next slide Rob has identifies a whole host of different types of measures for farm income and under what extent they have some meaning. And Rob, I might ask you to comment briefly about gross income and estimated taxes. Those two things kind of go together, and they provide a very unique benefit to a farm operation, especially when and how they make estimated tax payments.
Correct. Thanks, Bob. What you're going to find is that for different provisions, these aren't just in the tax code. Some of these are treasury regulations. That's what the TR stands for in this citation. But it depends on what you're talking about, where when calculating gross income for farmers, the rules under that specific provision might differ a little bit from what we use for calculating estimated taxes. And the same thing holds true for soil and water conservation or any of the other items listed here. The nuances, there's going to be minor variations with these all across the board. So it really turns into an individual look-see. And folks, the only soapbox thing I'm going to get on here off topic slightly is that I encourage everybody to be a good consumer of professional services. There, farm tax returns are fairly complicated. And one of the scariest calls that I get during the year is somebody will call me and they'll ask a ton of questions about stuff, and then finally extract out of the conversation, oh, I'm doing my own return. And there are so many rules and everything. I really think a lot of folks do themselves a disservice if they aren't seeking out a professional on this. So with that, what we have, the additional definition that we have here that we want to talk about here a little bit. This is a definition that comes out of publication 225, which is the Farmer's Tax Guide. For those of you that aren't aware of what that is, that's a publication that's been around since the late 1940s, and it's a very good publication. There's a new edition every year. It goes through all the components of a farm return. It's a very good resource. But what Pub 225 does to help define this is, you're in the business, if you're a farmer, you're in the business to cultivate, operate, or manage a farm for profit, either as the owner or the tenant. And there needs to be a profit motive in this. We don't want to get into hobby loss rules too much because of time limitations, but the hobby loss rules, we need to be concerned with that, especially with a small farm, because a lot of times a beginning small farm, they may have an acreage with a couple outbuildings, and maybe they have a couple cows or some sheep or a few chickens, and they're selling some eggs. And that's all fine and dandy. There's farm income there, but what they need to be careful of is what kind of expenses that they're allocating towards that enterprise. I've seen returns where somebody has a couple cows on an acreage and they file a Schedule F, and it ends up with like a negative $30,000 loss. That's really not possible, folks. So we need to be careful allocating that, and that's another reason why we want to have I think you need to seek out a qualified tax professional on that. Every so often the farm has to make money. I mean, that's just kind of the bottom line. Bob, you got any? Yeah, I know you have a wealth of experience with that as well. Any comments?
Well, we know the tax courts have tons of cases about the hobby loss activities. There are times when taxpayers win. There are lots of times when the IRS wins. So yeah, identify your income and expenses properly. If you're spending money that you wouldn't otherwise have spent except for your goal to make a profit with your farm operation, those are going to be sound business deductions. Remember the other general phrase here: deductions must be ordinary and necessary to conduct your trade or business activity. That's also another limiting factor. Rob, the estimated tax payments we'd mentioned just a moment ago has a little more detail on our next slide, because this is a very unique chance to qualify as a farmer and have a beneficial way to get your taxes paid on an annual basis. Rob?
Yes, this is probably one of the greatest advantages to being a farmer in IRS's eyes. Now, we spent a lot of time talking about what's farm income and what's not farm income. In order to be an in order to be a farmer in IRS's eyes, you need to add up all of the farm income and then compare that to the total gross income that particular taxpayer has. 2/3 of that gross income needs to be from the farm. If that's the case, then that producer meets that farmer definition under the IRS rules. Now, the benefit of that is that then that farmer is not subject to the estimated tax rules that all the rest of us have to abide by. Normally, a non-farm business, those individuals are going to be making quarterly estimated payments. For those of us that have W-2 jobs, our employer is withholding income tax from those paychecks, and that's where our estimated payments are coming from. So, if the farmer, if the person is designated as a farmer, they don't have to make those estimated payments. Now, the trade-off for that is that if they make no estimated payments, their tax return is due March 1 instead of April 15th. If that producer wants to make a January 15th estimated payment, then that extends that tax return until April 15th. So there's some flexibility that comes into play with that. But this is a huge thing where producers don't have to make estimated tax payments. They just have to file the return by March 1.
Yeah, there's lots of ways to otherwise qualify the amount of the payment here and make your determination on the proper filing date to avoid any underpayment of estimated tax penalty. In prior years, those have been relatively low when interest rates were 2 or 3%, but we certainly expect the IRS to have much higher interest rates at the end of 2022. So those penalties will be much greater than they had been in prior years. So plan accordingly here. One other note I would say, Rob, I think we're often surprised that machinery sales are not deemed to be farm income for this definition of an estimated tax payment. So again, proceed with caution, get the details. And I also got a couple of examples. Rob's going to take us to Colorado for the first one.
Yes, this helps explain how this scenario might work. We got Jose, Colorado sheep producer. Jose's full-time job is farming. All right, sells market lambs and wool shorn from the flock. That's all Schedule F income. In fact, there was somebody in the Q&A that was asking about selling mohair from goats. That's going to be Schedule F income. So that's all going to be farm income. Jose's primary source of income is over 2/3 of his total income. So he meets that IRS definition of a farmer, and he's eligible to take advantage of the farmer estimated tax payment rules under his circumstances. Now, contrary to this, next slide, we got Susie. In this case, she grows herbs. Now, a little bit of background on Susie. Susie also happens to be a computer engineer. All right, we don't know who she works for, but she works for a software company, and we're assuming she has a pretty healthy W-2. And she does this growing herbs on the side. So, and the given information, it says the herb sales are a small part of her income. Since her horticultural activity is less than 2/3 of her total income, she doesn't qualify as a farmer in IRS's terms, so she doesn't get to take advantage of the estimated tax rules under this set of circumstances.
Rob, our next 4 slides really get into some nitty-gritty of the benefits of being a farmer and meeting that definition. This first one is extremely valuable, installment sale of farm products, because it's one of the sort of reverse tax planning options you have available. An installment sale occurs when you have at least one payment made in the year after you've had a sale of that product. And so often in Illinois, for example, our cash grain producers deliver grain in October, but have it sold in January or February and collect payment then. And so that's an installment sale. They've sold it in October, but get payment in the year after the sale. And so they're going to report that income in the following year. So now that would be a 2023 receipt, it'd be a 2023 taxable income. Lots of details about making sure you have a contract that says how that's going to happen. But the other unique piece about these installment sales, Rob, which get reported on Schedule F in the year after production typically, there's a way to elect out of this installment method. And if you want to, you can move a deposit from January of 23 back into 22 taxable income by virtue of these very flexible installment sale rules. Rob, what else about installment sales would you like to describe, and then I'll let you take us to the fertilizer we use to produce the crop.
Well, let me digress here just a moment on this. I guess what for assuming that we have this beginning group here, I guess I had cash basis highlighted here and just wanted to touch on that real quick just to differentiate what this is. Accounting wise, if you have a farming operation or any business for that matter, the cash you're going to have one of two accounting methods. You're either going to be cash or accrual. Now, the vast majority of folks are going to be cash, and all cash amounts to is as you make a sale or as you pay a bill. That's when that transaction gets booked in your records. On accrual, if you're on accrual basis, what happens is you still write down when you write all your checks and everything, except what at the end of the year, what you do is you take into account changes of your beginning and ending inventory from the beginning of the year to the end of the year. And that's used to calculate your profitability. All right. Now, most folks do cash. So when we say cash basis, that's what that is referring to.
Yeah, we have what, a $26 million plus threshold that if you're below that gross receipt level, you're automatically eligible to use the cash method, which is simpler and gives you some flexibility.
Okay, very good. I can take a stab at this here. As far as fertilizer, this is an old rule that's been on the books for a long time. A farmer has the option with fertilizer. They can either originally fertilizer was supposed to be amortized, spread over a number of years. There's an election under this Internal Revenue Code 180 that expensing fertilizer every year is actually an election that you make on the return. You do have the option to spread that fertilizer out if you want to, but that's just something that farmers are able to do. Now, most farmers that I've ever come across, we always expense the fertilizer on the tax return.
Rob, I see one chat question about to your herb example. The question is, would the same answer be true if our farm business is totally separate from our personal income sources? Well, for that to be applicable, it'd really have to be a separate, entity over there, a separate schedule or a separate corporation, LLC entity that might be separate. But still, if that's a pass-through income to her individual return, and she has $50,000 of herb sales and $150,000 W-2, she still would not meet the definition of a farmer, even though maybe the S Corp looked like it was a farmer, but individually she would still fail that test. The next slide, Rob, gets us to a business use of a vehicle, and there's some benefits here. We have a safe harbor that farmers can use without the need to record or substantiate contemporaneously their business mileage. So this is a pretty beneficial one, Rob, for helping cover the increased costs we have today of operating a farm vehicle, or depreciation and fuel and insurance and interest. All those items are much larger today than a few years ago. So the safe harbor is pretty helpful, Rob.
It is. Just a couple things to note on this is that the vehicle that you do this safe harbor for is it needs to be used substantially in the business. You don't want to just do this on a personal auto. It needs to be a vehicle that's actually used in the business. And also safe harbor was something that we probably wanted to define as well. Safe harbor is IRS has safe harbor rules all over the place. And what a safe harbor is it's where IRS will allow you to do something as long as you meet certain criteria. And I think that's probably the easiest way to explain that. We have safe harbors for the vehicle use. There's safe harbors for repair regulations, and so as long as you have criteria that you're able to take a deduction as long as you're driving between the lines of sorts.
Yeah, I liken it to the net that lands below the trapeze artist, right? So it's the safe harbor that lets you dance along the wire, but it's there to give you a very basic allowed deductions without further contemplation. We have one more unique topic that Rob's going to cover, and then we're going to come to Tammy to talk about how you find someone to help you work through all this. But Rob, probably the most unique feature of being a farmer, as using the proper definition, is this grand thing we call income averaging. So tell us a bit about this Schedule J form and how this helps lower tax liabilities.
Well, Schedule J is a unique form. It allows us to, it isn't really averaging the income. What it does is allows us to blend the rates of sorts. Now, you have to be a farmer under the generic definition in order to qualify for this. I think the simplest thing to do is, let me just go to this next slide on this. Now, this was a slide that I used for my 2021 ag tax school, but it's still applicable. In 2022, all the numbers are going to be 1 year advanced, essentially, is what's happening. Now, we're currently in a time frame where we have a 12% bracket, a 22% bracket. Below this, it would be a 10% bracket, but that doesn't really affect the graph here. What this graph is reflecting is, let's say that these bars in 18, 19, and 20 is the amount of taxable income that the producer had in those respective years. They have a lot of, in 2021, they had a high level of income, well above the top of the 12% bracket. They were into the 22% bracket. What income averaging allows us to do is it allows us to take income from 2021, and we have to put it equally back into those prior years, thus allowing us to utilize some of those lower tax brackets that were unused in a prior year. This works for both ordinary income and capital gains. We haven't gotten into self-employment tax and regular tax, but this does not affect self-employment tax. So self-employment tax is untouched from income averaging.
Yeah, the unique piece here, I think, is that it's a look back. So you can take your current revenue and you know the result by looking back to the 3 prior years and how much money is available in each of those lower brackets. You know you're going to fill them up to the maximum of 22%. So I said a quick example in my head. Let's say I had $30,000 of income in the 22% bracket. I'm going to be able to push that back 10, 10, and 10 into 18, 19, and 20 on this slide. And that 30,000 will be taxed at 12% if I have enough room. We tax at 12% instead of 22%. So 30,000 move back, saves here 10%, or $3,000 of an advantage of using income averaging. So if you find your Schedule F is bigger than you anticipated, don't fret it. Look at income averaging. That can help mitigate some of the issues. Rob, I'll let you look at the Q&A. Let's bring Tammy on, and Tammy's going to describe how we're going to help someone find a tax preparer to work them through all these things that Rob has been providing for us. Tammy, good afternoon.
Good afternoon. Thanks, Bob. It's very interesting listening to who's a farmer and who's not a farmer. And this is really put together to kind of recognize that not everybody knows some of these definitions and understands some of the nuances of this. So I'm Tammy Cushing. I'm housed at the University of Florida here in sunny Gainesville, Florida. I am a forester by training who is also trained in taxes. So hence why I wasn't too active in that last conversation. So Rob, if we'll go ahead and we'll dive right into how to choose a tax preparer. So first off, you would tell anybody this, and you can find this on the IRS website, is to really start looking at the preparer's qualifications. And you're going to have to ask that question. Maybe it's on their website, maybe it's on their door, hanging on their wall, and you're going to see some alphabet soup. And the point here is not to really tell you what all the alphabet soup means that you see on the screen, but rather just to show you some of the letters that you might see that represent the different qualifications people have. So that might be that certified public accountant, enrolled agents, different licensings that come within different states, the licensed tax preparer, tax consultants, could be certified financial planners. It might be an attorney. And then that PTIN, that's a paid tax identification number. And so these are just the different type of qualifications, and they all come with different backgrounds and different rules for how they get those qualifications. So it's great that they've told you that. What you really want to do is go ahead and check that. So anybody can say it. We know nowadays anybody can produce a certificate. Go to the IRS directory. We'll have links available for you to see those. Can plug their name in, check their qualifications, and make sure that they are current on any training that they're supposed to have. So that's all great. The next step really is to just probe a little bit more and find out about their history. We like to think everybody's a good actor, but you should always verify that they've done things properly. You can ask the Better Business Bureau where you are to see if there's any complaints been lodged, realizing that not all complaints are well-founded. You can check into disciplinary actions in different places and check the license status. So if there's CPAs, you're going to look at your state board of accountancy. Every state has one. You can go online. Usually you can plug their name in and it'll bring up if there's been any issues. Same with attorneys. They have state bar associations. And then of course, enrolled agents are directly tied to the IRS. You can verify their enrollment status and make sure. This is just checking to make sure they're doing their continuing education and that there's been no cause for concern. Just doing your due diligence. If you're going to trust somebody with your financial data, it's always good to do these kind of checks. Rob?
Yes.
Yeah, those are good ones, Tammy. We're going to get into more pieces about choosing a tax preparer, and even about the fees. Nobody likes to pay fees, especially me, but if you're getting good service, it's a good investment, right, Tammy?
Absolutely. And so, you know, it's great that somebody's qualified, and there are a lot of very qualified people out there, and you've done those last two checks, and we know that they can practice. We know that they can file for you. The next question, and most pertinent to the conversation we just had, you want to ask them about their experience specifically with farmers, ranchers, and forest land owners, depending on what your property actually looks like. There are so many definitions of a farmer, as you just heard, that you want to make sure that the person doing the return understands the nuances there, that they understand that there's specialized tax rules. We have a lot of special rules within forestry as we do within ag. You want to make sure that this isn't the first time that they're hearing some of these terms. I know that having done some trainings that I've stood in a room and I've said the word culvert and found that many of the preparers in the room weren't familiar with what a culvert was. If they aren't familiar with what a culvert is, or they aren't familiar with your combine or maple syrup production, then there's a likelihood that they aren't going to know how to treat the revenue and the expenses that you bring into them. So you want to prefer that they have that range of experiences that are similar to things that you might experience. I know in forestry, we're talking about different types of timber sales, putting trees in the ground and understanding special provisions that exist for reforestation. Maybe you've had a loss situation, or you want to make sure that if you do, that those preparers are aware of casualty loss rules and how they apply to different farm, ranch, and forest land situations. I know within our group, we've talked about breeding livestock and how that's treated if you've had a disaster in your area. Ask these kind of questions. You also want to know if they've been working on small farms versus big farms, because the experiences are different. So ask these kinds of questions. You then want to ask them about their service fees. They're checking all the boxes for you. Now you need to know how you're going to be charged. What we're trying to do here is avoid surprises. The last thing you want is to have somebody do all that great work for you and to find out, wow, that was way more expensive than I anticipated. So it doesn't mean you should use somebody different. It's really just to upfront kind of have the conversation. I always tell people it's great to have these things ahead of time. That way you know what you're asking and you're not surprised when you get a bill for the phone calls or a phone call for them handling your emails. So you're often going to see the billing done by the hour or by the form. And that's really to kind of recognize that more complicated returns require more forms and more time. And so you just kind of want to understand that up front. We want to advise you to avoid preparers who base their fees on a percentage of your refund, or who go about telling everybody they get their clients the biggest refunds in town. There might be a reason for that. Maybe they're just that good, but you should probably investigate that a little bit further. When you're having these upfront conversations, do not give them any of your personal information. At this point, we're not contracted with anybody. They don't get your social security number. You don't give them any personal information until they're actually working for you. Rob, I think we're ready to move on to the next. So we often make assumptions that everybody's available for us all the time. And of course, that's not always true. So we have come at a full tax cycle, and we're behind that now. Now's a good time to reach out if you're looking at finding a tax preparer that's versed in these ag and forestry issues. Go ahead and contact them now. Find out if they're accepting new clients. Ask all those leading questions to try to interview them and see if it's a good fit for your situation. What you don't want to do is be looking for somebody April 1st. You're probably not going to find anybody, and anybody you find April 1st, you might want to ask some more questions to try to understand what's going on. And you certainly don't want these people that come and go just overnight, right? So these fly-by-night preparers, you probably want to avoid them. One of the things I like to advise people to ask is how your preparer handles some of these gray areas. What I mean by gray areas is you heard us trying to figure out this maple syrup thing, and I keep coming back to that because that's an area I wasn't prepared for. And so we're going to have preparers that maybe don't know the content but are willing to do the homework. That's great. Even when we start doing the homework, though, we find that there are gray areas within the tax law that it's not cut and dry. One of the gray areas within forestry is usually talking about roads and what those roads are there for and how we're going to treat the roads. How is that tax preparer going to handle that particular gray area? What you want to find out is, are they going to be overly aggressive? And if they're going to be aggressive, and you by nature are more aggressive on how you handle these financial affairs in your tax returns, then that's probably fine. If you're more conservative in how you view readings on tax law and how you feel about that, then maybe this isn't a good match for you. On the flip side of that, if this tax preparer is a little bit more conservative, not likely to take some risks, and you want to be more aggressive on how you claim things that are in those gray areas, then this also is probably not a good area for you, a good match for you. So the best combination is a preparer who really is in your comfort zone. At the end of the day, they're going to sign the tax return, but it also is your tax return. Bob, Rob, any thoughts on that particular topic?
I think when I was preparing a lot of returns, people asked me, what's the chances IRS will look at your return? And my answer was, it is absolutely 100% that they will look at every return that I've done. Because as a P10 preparer, IRS could very easily just grab my P10 database history and look at the returns I've done. So if people think they're playing auto roulette by getting a low level of that, I think that's wrong, because it's just too easy for the IRS to run an easy report on all the returns that Bob Ray did and how did he handle farm depreciation. So I think they look at a lot of them under the computer system. I think connecting the preparer and the taxpayer together in the right frame of mind is a great idea.
Great. Thanks.
Completely agree.
Thanks. Yeah, it's always interesting because there's just some of these, we all think that it's just black and white in this tax law, and clearly it isn't. And so you're going to run into these gray areas. So get that conversation up front. And then you want to find out the limits on audit representation. Not everybody will do everything you could possibly need. And it's really good, I think, up front to find out, if I get audited, are you going to hand me off to somebody else, or are you going to see me through the process? And some of them are going to be honest with you and say, I'm not going to see you through their process. I'm not allowed to see you through the process. There are limits to how far I can go based on my training and my qualifications. And so you just want to be aware of that. And that's really just a communication up front. Of course, you would hope you're not going to get audited, but you kind of just heard from Bob and Rob that those things happen. And sometimes they happen with the same preparer. And so you kind of want to have those conversations up front to understand. And then, of course, how am I going to be charged if we go into that audit? What is that going to look like for me? Rob?
All right.
So now you've chosen someone, you've asked all the questions, you've done your due diligence, you feel comfortable with who you've chosen. So the next step really as you go into tax season is be ready to show them some of your previous tax returns to show how the types of issues that came up in previous returns so that there can be some consistency maybe in how questions are answered. They're also going to want to see your records and your receipts. And what they're trying to do is really put you in the best position going forward. Really providing these records and receipts ahead of time can also allow for some strategizing. That's really something you would like to do ahead of time. If you walk into your tax preparer's office and you drop all your receipts and records in their office in February, nothing can be done other than to file. If you've talked to them September, October, there's some things that they can strategize on how are we going to work out through the rest of the year in order to put you in the best tax situation as possible, obviously staying on the right side of the tax laws. Along with that, never ever sign a blank return. So if the tax preparer asks you ahead of time to go ahead and sign this return so that we can expedite things, the answer is no. We're not going to sign that ahead of time. You are responsible for what's on that tax return. And so if you've signed it, you're acknowledging that you know what's on it, you understand what's been done and the positions that have been taken by that tax return preparer. Next slide, Rob. So you didn't sign it ahead of time, but now you've been handed your completed return. You should review this return before you sign it. And if there's anything you don't understand, now is a great time to ask questions. Hopefully this is not happening on April 14th, but this is happening a little bit earlier. So you have some time, ask the questions. You find out that maybe there was a misunderstanding or a miscommunication between you and your tax preparer. That gives you some time to fix things if needed. You want to make sure that any refund that you're going to get is coming directly to you. You are not going to have that refund going to your tax return preparer. It comes to you. You're going to pay them separately outside that transaction. And then, of course, you want to get a copy of that completed tax return. It's surprising the number of times you need to produce your completed tax return, whether that's for a mortgage, some kind of loan. It's always easier to have that information in your possession rather than having to go chase that down when you need it. You want to make sure that you sign it, but also that your preparer signs it. And then, of course, any paid tax return preparer is going to have that PTIN number, and it has to be included on your tax return. By law, they have to, if they're paid, sign it and include their PTIN. Rob? We hope that we don't have to do this. We know that we're going to assume that most people are honest and they're putting their best foot forward and doing the best service they can for you. But occasionally there's a bad actor out there. Should you run into a bad actor and you have some suspicion of abuse, you should report that to the IRS. Not reporting it, while that might feel like the right thing to do because you suspect it, but you're not sure, let the IRS do their diligence on checking into that. If you don't report it and they are actually doing something abusive, you're just putting another taxpayer at risk if you don't report it. So go ahead and report it. These forms will be on the website available for you. There's an official form to file the complaint. If you suspect they've changed your return without your consent, there's a separate file for that, a separate form that you would file for that. So, Bob, Rob, any other tips that you have in selecting or what to do as we proceed?
Well, hopefully after today's webinar, you might have some specific ag farm tax related questions you could ask a preparer. And if they've never done a Schedule J, if they've never helped someone calculate estimated tax payments on January 15th, that might be an indication a different person should be interviewed to assist you. And if they are unfamiliar with FSA programs and 1099s, those might be some other specific issues you might ask to dig a little deeper for some specifics about what that person really does know about a farm tax return getting prepared. Thanks, Tammy. Rob has the next slide as we just kind of wrap up here with some other resources that are available. And these are all available free of charge and all well-designed resources that can help you continue your study about the farm tax planning. Rob, we have 3 questions pulled up here. You ready for some rapid fire ones, my friend? Tammy,
Sure.
jump in if you'd like. Land is enrolled in CRP. Different tax status because we're actively managing CRP. Well, that's a hotbed question. There's a whole case called the Morehouse case that tells us a lot about that. It also depends if you're already drawing Social Security benefits or not and collecting CRP income. But generally, I'm going to say yes, you're a farmer. You're probably actively managing farm ground and farm program payments, which is a whole another piece of the gross receipts we haven't described in much detail. But any of those farm program payments, crop insurance proceeds, custom work related to your farm activity, all of those are different types of farm gross income. Rob, additions?
No, that's it. That was where I started to type an answer into that, and then I'm going, all right, they aren't going to want a book. So I thought we
Yeah.
better answer this one correctly. But this is one of those folks that honestly the answer is it depends, because Bob hit the nail on the head. There's times some people don't have to pay self-employment tax on CRP, and most others do. So it depends on which camp you're in as to the type of treatment that that you're going to be able to get from that. So that's one of those that you probably need to sit down with the tax professional one-on-one to get that really really nailed down.
Yeah, if you have CRP, you can ask your preparer if they're familiar with the Morehouse case. If they're not, they need to study. Process for farmers to get a tax number for farm purchase to be tax-free. Well, this is a sales tax question. Sales tax is something that's guided by every state differently. In Illinois, all of the farm purchases we make for inputs and farm equipment have a sales tax exemption applied by the Illinois Department of Revenue. We don't need a separate tax number for those. If you're someone who's doing processing, you might want to get a tax number to be called a reseller, and that would eliminate you from having to pay sales tax on your purchases, but would require you to collect sales tax from all of your otherwise taxable sales. Last one, Rob, feedlots, meat processors, direct to consumers, produce sales, those Schedule F people. I think some of those look like Schedule F to me, some look like Schedule C. I'll let you give us the final word on that one, Rob.
Well, folks, I think what you need to look at, if you're selling something on the hoof out of a feedlot, it's unprocessed, that's going to be Schedule F. So, you know, if you as your farm are selling an animal to somebody else and then they're going to have it processed, then it's Schedule F. Now, if you're a meat processor where you're processing that, that's going to be Schedule C, non-farm income. The direct to consumers produce sale, I'm assuming that the individual maybe is talking about a the co-op farms where they get a basket of goods every week, and I'm drawing a blank on the
like the
acronym.
delivery produce.
Yeah.
CSA.
CSA. That's what. Thank you, Tamara. That's
Look
what
at that. Everybody's chatting in CSA. Thank you.
Yeah, that's having a little brain lapse there, but yeah, the CSA. That's going to be Schedule F. Slam dunk.
One final question, as you see our contact information, we'd be glad to hear it from anybody who joined us today, was about self-employment tax liability, and you're the landowner and you get income based on a percentage of the grain and government payments. So the issue there is, are you materially participating in the farming activity? If so, you're going to be subject to self-employment tax. If you're merely a landlord as a crop share person and you're really not involved in that activity, you're going to file not the Schedule F to report your farm income, but Form 4835 for these non-materially participating persons, and no self-employment tax will accrue if you are a non-materially participating landlord. So a lot of heavy details to close that out, but that's a great question. Robin and Tammy, I thought the questions and chats we had today were not only on target, but exceptionally well written by our attendees, and clearly told me that they were understanding and interested in a topic provided today. There is another webinar scheduled for August 15th at 1 o'clock. It'll be using a tax estimator that our friend from Clemson University, Adam Kantrovich, will be walking you through to get into some real nuts and bolts about calculating tax liability from these farms that Rob and Tammy have helped us define and clarify today. Thank you for joining our USDA Farm Income Tax Extension Committee experience. Good luck in your 2022 tax planning and tax filing season, everyone. And Sarah will let us know that this recording and PDF of the slides will be available to participants who've registered in the coming days. Thanks, everyone. Happy rest of July the 12th.
Thank you.